Welcome everyone to this M&I Connect video conference, which is being live streamed to a wider audience. I am Kevin Woodfield, responsible for M&I Connect events program, and it's my pleasure to introduce our distinguished speaker on this occasion, Luis de Guindos, Vice President of the European Central Bank. The Vice President very kindly joins us to discuss the Euro area growth and inflation outlook in light of the latest set of quarterly projections presented last week at the Governing Council meeting, when the ECB took the decision to cut interest rates, having raised them by a cumulative 450 basis points between July 2022 and September last year. The Governing Council did so despite the latest projections showing a higher near-term growth and inflation outlook compared to those produced in March. But the ECB expresses confidence that inflation, core as well as its targeted headline measure, will return to 2% in the second half of next year. Indeed, the ECB has underlined the robustness of its quarterly projections, going back for a year now. But at the same time, it insists on a meeting-by-meeting approach to policy setting, stressing considerable uncertainty at home, with a focus on wage trends and sticky services prices, and abroad, with war sadly raging and trade friction intensifying. And perhaps we can add political risk to the mix in light of the weekend's European parliamentary election results and the impending vote now in France. It's therefore an ideal time to assess where the ECB's inflation fight has reached and the sensitivities around the outlook. We are delighted, therefore, to have Vice President de Guindos with us today. He has, in fact, just marked 6 years in the number 2 position at the ECB, after spending the previous 7 as Spain's Minister of Economy, Industry and Competitiveness. In a previous stint at the Economics Ministry, he oversaw Spain's entry into the Eurozone. And in between, he has worked at PricewaterhouseCoopers, Lehman's and Nomura, among other firms. This M&I Connect event will run for up to 1.5 hours, and Vice President de Guindos will make very brief opening remarks, a minute or two, and then we will move to questions and exchanges with our guests here in the auditorium. As I mentioned, this event is being live streamed to a much wider audience who are listening in, and I welcome you all. Everything discussed here is public and on the record. I thank you all for your attention. Luis, thank you very much again, and I'm going to give you the floor, and I'm going to come and join you actually on the table here.
Well, thank you very much, Kevin. Good afternoon to everyone. It's a pleasure to be here with you. Thank you very much to M&I for this invitation. And I think that the timing has been quite convenient, because we had the Governing Council meeting last week when we took some decisions with respect to monetary policy. We produced our staff projections, and we released our staff projections. And I think that even the timing from the political standpoint is also quite convenient because of the parliamentary elections in Europe this weekend. That I think that is going to have an influence on what might happen in Europe, in the euro area, over the next weeks. I believe that the most important and the most relevant part of this kind of events, of this kind of exchanges, is the Q&A. So initially, I had prepared, a speech of 30 minutes, but I was told that that was not very, very convenient, and that it was much better, to leave a space for your questions. So without further ado, I am totally open to your questions, and perhaps, I will introduce, my initial remarks as part of the responses that I went to make to you.
Excellent. Thank you very much. Very succinct opening comments. Okay, we're going to move straight to the Q&A. If you simply raise your hand, and when I spot you, I will bring you in sequentially. Please, and I will invite the Vice President to respond to each questioner in turn. And please turn your microphones on, if you would, when you're speaking, and turn them off when you are not. So thank you very much. And Jan, right in front of us, please go ahead, Jan.
Thank you. Jan Vliegen from Millennium. I was wondering, could you give us a bit more color on the tone of the communications after last week's meeting? So, we all understand very well that you can't promise and can't commit and data dependence, etc. But personally, I was a little bit surprised by this confusion around, have we entered a new phase of monetary policy? Yes, no, maybe, in all likelihood. It seemed a little more difficult than it needed to be to get that point across. And I was just wondering if we can get like a slightly more elaborate version from you to clarify that. Thank you.
Well, thank you very much for your question, because I think that that's ideal in order to introduce or to make some remarks. And I will refer a little bit about to the outlook. That is the framework where we are going, that we normally make our decisions. I will try to explain why we have done what we have done and the decision that we have taken. And finally, I will refer about a little bit about expectations about the future, etc., etc., etc. Well, first of all, what is important to bear in mind is that the disinflationary process in Europe has been quite intense, quite profound. I'm not going to repeat, the kind of figures that by heart, but just to remember that, for instance, in October 2022, inflation in the euro area was 10.6%, and now it's 2.6%. So the disinflationary process has been quite profound, quite intense. And even if you look at core inflation, that is a little bit below 3%, all the measures that we have of underlying inflation go in the same direction, that inflation is going to decline. In our projections, as Kevin has indicated, we review up a little bit the outlook for growth. It was a marginal increase because growth for 24 is going to be, according to the projections, 0.9%, a little bit below 1%, clearly below the potential of the euro area. And we also reviewed up a little bit both headline and core inflation for 24 and 25. But the changes were quite marginal. And let me say something that because, I can understand a little bit the surprise of having, a rate cut and simultaneously to have, to release projections with higher inflation. It was, we knew perfectly at the beginning of the year that from April, May until year end, the evolution of inflation is going to be bumpy, it's going to be complicated. It's going to be hovering around, the levels that we have now, headline around 2.5, core a little bit below 3%. So it was not a surprise for us. It confirmed our confidence that inflation will converge in 25, at the end of 25, to the level that defines our price stability objective. So that was, something that it was relevant. I know that it created, to try to explain, it was a sort of a challenge. You have to explain why you have reduced rates when you are marginally reviewing upwards the inflation outlook. Having said that, and looking at the future, let me say something that in my view is relevant. The future is going to be complicated. The evolution of inflation over the next months, as I have told you before, is going to be hovering around the 10% levels. Base effects are going to be relevant, and we have another element of uncertainty that is going to be the evolution of the main risk for the inflation outlook is going to be services inflation, what we call domestic inflation. In that respect, we have to analyze what's happening in the labor market. Wage dynamics are very, very relevant. Yesterday, we had some data from the European Commission about compensation per employee. It was in the area of 5%. You can say, well, is it compatible with bringing down inflation to 2%, 5% compensation per employee? What I have to tell you in that respect is that this is exactly the assumption that we had in our projections for the first quarter of this year. Nevertheless, our projection is that compensation per employee will start to decline and will start at the beginning of next year in area of 3.5%. The second element that we try to take into consideration that I think that is very, very important and that we are paying a lot of attention is the evolution of productivity. The evolution of productivity in Europe has been very, very thin, even in some quarters negative. And so the combination of wage increases in the area of 5% plus, very low productivity, gives rise to unit labor costs that are a real threat, for the future, mainly in the services sector. In 2023, the increase in the rise in unit labor costs was mainly compensated by profit margins, and it was a good idea, a good development, in the sense that, well, in 22 there was an increase, in the margins in Europe, and in 23, and we believe as well that is what is happening now at the beginning of 24. Margins and profits, they are absorbing part of the increase of unit labor costs, and so the inflationary pressures will start to be partially compensated by the reduction of profit margins. On top of that, you have all the geopolitical risks. Well, I'm not going to repeat what you know perfectly. Ukraine, Middle East. On top of that, we have political risks, no geopolitical risks. Well, I suppose that afterwards, we can comment a little bit about the situation in the European Parliament and what's going to happen, the outcome of the elections, the potential impacts that this might have in terms of policies in the euro area. So that's why we want to send a very clear signal in terms of the future actions that we are going to take. And the level of uncertainty is huge. There are a lot of question marks. And that's why when you are, in a dark room, you have to be very careful. You have to only, to move very slowly, to move with a lot of prudence, and to try to clarify, what might be, the future. So that's why, well, I'm not going to repeat our motto of meeting by meeting, data dependent, etc., etc., etc. But the main message is that we do not have any sort of predetermined path of evolution of, decisions of rate cuts over the next 6 months. Because I think that's the correct approach. I understand perfectly that markets wants to have forward guidance, if not forward guidance in the sense of the traditional monetary policy approach, a lot of guidance. But it could be be careful when someone in these circumstances gives you any sort of very specific concrete guidance about the future evolution of monetary policy, because for sure that he's going to try to cheat you, or he doesn't know anything about what might happen in the future.
Yeah, would you like to follow up? That's good. I'm going to go to Chris, and then Manu, I'll come to you. Chris, please.
Thank you, Chris Grove from Capula. Thank you very much for this, Mr. Vice President. We had a very enjoyable conversation earlier about football, so I'm going to move on to a less interesting topic of inflation. You've discussed some of the topics I wanted to raise around the strength in unit labor costs, which are running a little under 6%, so quite concerning at this point, and not moderating as we've seen in the US and even now in the UK. We saw the May services number, which on the ECB's seasonal adjustment was running at 5% month on month, and that's a number which isn't reflected yet in the forecasts you published previously. So I just wonder if you could sort of give us a little bit more sense of where this confidence comes from in terms of the sort of reduction of inflation, the sort of monotonic reduction in inflation back to target. Do you have any concerns at all that this is just the traditional macroeconomic model forecast, which sort of inevitably has inflation falling back to 2%, no matter what you throw at it? Or are there more specific reasons for this confidence that you have? Thank you.
Well, thank you very much for your question. Well, it's not only the modeling, the traditional modeling. We believe that there are some factors behind, and for sure that we are using different models, no? But it's not the regression to the mean, to the 2% that usually these models imply. But going back to our inflation outlook, I want to be very clear. The data of inflation over the next 6-7 months is going to be you can call it the last mile, or a little bit before the home stretch. It's going to be bumpy, and I want to it's something that we want to stress and to highlight and to communicate to markets and to the external world. Base effects are going to be relevant. The withdrawal of the support measures by different governments, the support measures, to alleviate the energy shock, are going to play a role. But on average, let me say something. Inflation, the headline inflation, is going to be very close to the present level over the next 5-6 months. Nevertheless, for the future, for the next year, we clearly believe that the disinflation process will continue. The disinflation process will not come from 10.6, will come from something like 2.5 or close to that. So we are fully convinced that letting aside any sort of exceptional exogenous factor that is difficult to discount now, and that is beyond our control, we firmly believe that we have a lot of confidence that inflation will converge in the second half of 25 to 2%. We always, you have to make assumptions. When you make projections, it's not only the models. Sometimes the problem is that the assumptions are not the correct ones. But here our assumptions are quite prudent. In that respect, we have a high level of confidence that we will be able to reach the 2%, and that's so our mandate, will be met. It's not only models. Models play a role. But I think that simultaneously, is the, let's say, the prudence of the assumptions that we have included in our models in order to define and to produce this kind of projection at the end of 2025.
Chris, do you want to come back? No, you're happy with that? Could I just, Manu, I'll come to you next, just drill down a little bit on this concept of bumpiness, which I think is seen through to the end of this year. How would you weigh the risk that influences medium-term inflation projections? So, for example, what is the risk that your expectation of hitting the target in the second half of 2025 slips into Q1 of 2026? And if so, what would the implications of that be?
Well, if you look at market expectations, they are well anchored, and they are well anchored around the 2%. So and even that happened in much more difficult times. When we had inflation, I could not say when the inflation was 10.6, but even with higher inflation, always one of the positive things that we have discovered is that the expectations are anchored around the 2%. But I think that is a good indicator about the credibility of a central bank. And I think that now, even because you have different kinds of expectations, you have market expectations, household expectations, you can ask corporates, etc., etc. But all in all, and different kind of with different time horizons. But our assessment now is that expectations are well anchored around 2%. But I think that is good, for the credibility of a central bank, and in terms of our communication. I think that simultaneously is very, very important to be crystal clear with respect to what might happen over the next months. In that respect, the message that we have conveyed is clear. The next months are going to be difficult, but at the beginning of 25, we will start to see that the disinflation process, continues, and that we finally go to the 2%. But the next months for sure that are going to be bumpy. Why we believe that the next figures are going to be not as good as the previous ones. But the main reason is because we calculate the base effects. We have different calibrations. We have seen that in the case of energy prices, they are more or less stable around the present levels. We believe that productivity is going to grow. We believe that we will start to see a moderation of wages. Why? Because the catch-up process has been more or less will be more or less finalized in the next quarter. So that an important part of real wages, the drop in real wages will be recuperated, has been recuperated over in the last quarters and the last month, and simultaneously that profits can absorb part of the increase in unit labor cost. Those are the elements that are behind. And simultaneously, something that is quite obvious: our monetary policy works. You can have different views about how effective our monetary policy has been, but it's quite clear that 2 years ago inflation was above 10%, and now is much lower. And I think an important part of that success in terms of the fight against inflation. Nevertheless, we cannot be complacent, because I am telling you that the next months will be difficult, is the consequence of the monetary policy stance that has been applied.
Sounds like a school report. Good, but can't be complacent. Thank you. Manu, please.
Marco, Element Capital.
Oh, Mark.
Thank you for being here. I would like to follow up your question about underlying inflation, seeing this inflationary process, and what Chris mentioned about the May print. So we can see all the measures calculated by the ECB, underlying inflation is coming down. Those measures up to April, because we don't have yet the data, the breakdown for May. But if we look at service inflation, seasonal adjusted, produced by the ECB, and we compare to the same period of last year, we are roughly where we were last year. There has been no progress. So should we interpret that as that's normal? We are not worried. Is wages picking up, pushing up service inflation? Or there is a worry here that 2024 inflation is not just a bumpy process because of base effect. You're actually seeing now service inflation picking up more than what is embedded in the ECB view. And if that is the case, what the best policy reaction? Thank you.
Well, I fully agree with you that services inflation is going to be, the most difficult part of the task. But all the measures that we have, let's see. But here I am in a little bit of advantage with respect to you because I have a little bit more, our internal projections, etc., etc., etc. It's a marginal advantage. Don't believe that is big. I would say that you are right in the sense that the momentum of services inflation has gone up a little bit. That's but the measures when mainly the 3-month momentum. But when you look at the underlying measures of core inflation, underlying inflation, they always, and we have different, core, super core, hypercore, whatever you want to call it, all of them, point at the same direction, that is a deceleration. Perhaps, these are backward-looking indicators. So I think that what is going to be very, very important is wage dynamics, wage evolution. You have seen, some big numbers lately with respect to wages. It has to do mainly with Germany and one-offs. But if you start, to get rid of these, one-offs, the situation is that, and the evolution is clear, that wage dynamics indicate that salaries and, the wages are on the downside. And, in combination with a little bit of a recovery of productivity. And that's why, unit labor costs are going to start to be reduced. There are uncertainties, there are question marks. They are always, you're going to have difficulties for sure, but our baseline is clear in that respect. Policy reaction. The only thing that I can tell you is that we are fully committed to reach 2% in our time horizon, the time horizon that we have indicated. We believe simultaneously, because here the question is, how the past decisions that we have taken are going to continue, influencing the evolution of inflation. And I think that here perhaps, not 100% of all the decisions that we took, I believe, by personal views, that they have not been passed through to the real economy, to the great demand, and finally, eventually, to inflation. If you look, for instance, and I think that this is a very important report for us, is what we call the BLS, the Bank Lending Survey. It's very important for us. Well, there is a little bit of improvement in terms of the demand for credit and and credit growth, but very small, very marginal from very negative levels. And I think that it's clear that our past decisions have given rise, to a tightening of financing conditions, and that part of the the tightening of the financing conditions continue producing an effect on aggregate demand in the economy. So here is not only I think that I know perfectly that markets normally when you have when you have drawn the first derivative, they move to the second derivative or the third derivative. No, using the example of if Alcaraz has won Roland Garros, for sure that you want to know whether Alcaraz is going to win Wimbledon. And I don't know. I think that is a very good tennis player, and let's see what happens. No? And something similar with the European Cup. Of the European Cup, we will have the World Cup. Let's see what happens. But we have to take into consideration, the measures that we have taken. You referred, to the increase in interest rates, 450 basis points from very low levels, but 450 basis points of increase in our DFR. Well. My impression is that, and this is something that we can discuss afterwards, how restrictive our monetary policy stance is now.
Please, we'll come back in, Marco.
Yeah, if I may, I agree that Alcaraz won against Sinner at Roland Garros, but I think Sinner will win at Wimbledon. So I fully agree on that.
Well, let's see. There is a lot of uncertainty around.
Okay, thank you. I'm going to come to Fabio next.
Thank you very much. I'm Fabio Balboni from HSBC. So I wanted to follow up on what Ian said, but also specifically on the dropping of the easing bias in the communication. And I fully appreciate that. I think you explained it very clearly that the pace in terms of further adjustment is highly uncertain. You're in a dark room. But my question is the direction still clear? Because coming out of the meeting, I felt that maybe there was less clarity about the fact that, as if things evolve according to your forecast, the intention is still to cut rate further, and to what extent. And if I can paraphrase this and also tie into what you were probably hinting at before, are you still convinced that conditions at the moment are restrictive, or are you starting to consider that maybe actually they're not so restrictive anymore? Because until a few months ago, Christine Lagarde explained, I think quite clearly, that the first step was going to be removal of restrictions, and then the second step was going to be normalization. And I speak for myself, but I think most assume that anything between 4 and 3 was restrictive, and therefore the ECB would have tried to sort of cut rates relatively quick in that space. Are you now starting to change your mind on that?
Well, I think, and it's my personal impression, and I think that it's as well the view of the ECB, that the direction is there. The question is how intense is going to be the steering of our monetary policy according to this direction. If you ask me, how many cuts are we going to decide before year end? The only thing that I can tell you is that I don't know. There is a high level of uncertainty. But if you ask me, you are in the restrictive territory now with your monetary policy stance. Well, I would say yes. So that's something that the question is, I think that the direction is especially relevant if you take a little bit longer, than what might happen before year end, because afterwards, the direction has to be fulfilled with concrete actions, that really reaffirm the direction. And I have some, here the big question mark, given the uncertainty that I referred before, is what kind of steps are we going to take over the next months. But if you ask me, what's the direction in a period of time of, I don't know, before the end of 2025, I would say that the direction is clear.
Fabio, would you like to come back in?
Yeah, thank you.
Okay, good. I'm going to Reza next, and then I'll come over here.
Thank you.
Go
My
ahead.
question was along similar lines. You described your logic for why the guidance is more open-ended this time than the last few meetings. But some of the elements are not new. So the bumpiness in the data towards the end of this year market had, to some extent, internalized that. It was in your previous projections. And so the question is, in terms of the degree of restrictiveness, are you concerned that this bumpiness could unanchor expectations or could reverse the direction? Or is it that you are confident with the projections, but you're worried that the assumptions may not materialize, and therefore you may require a longer degree of restrictiveness at the current level than you were originally thinking? So what is the sort of your concern here?
Well, we are entering into the qualitative assessment of, our monetary policy stance. But what can I tell you? I am quite confident that our baseline about the evolution of inflation on inflation is going to be right. But simultaneously, I think that, the elements that could derail, this baseline are there. I referred before to geopolitical risks, political risks. Let's see what happens. No, for instance, fragmentation in the world economy, even fiscal policy, even the possibility of a financial stability issue, an accident. If you look at, because we are not paying attention to financial stability issues, but valuations of markets are very high, and they are discounting that everything is going to be very nice, very smooth. Valuations are very rich, but perhaps that will not be the case, or we can have an accident, an external factor, geopolitical risk. We have to analyze simultaneously fiscal policy. Even fiscal policy in the US. What's going to happen with fiscal policy after the US elections? No, well, these are all elements that we have to take into consideration. It's very, 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 very difficult to have. We have our baseline. Our baseline is based on assumptions that we believe that are realistic, but there are so many different aspects to take into consideration that that increases our prudence. I said before, I think that the direction is clear. The direction is clear, if nothing exceptional happens, and I hope that nothing exceptional will happen. But recently we have had quite a few shocks, in the world economy. So these are the elements. I am convinced that in normal circumstances the direction is clear, that we will reduce the restrictiveness of our monetary policy, and that we will be able, in parallel, to achieve our target. But the future might bring different kind of shocks and different kind of situations, that could derail everything, not only our projections, the projections of everybody.
Reza, do you want to come back?
No, I think my only comment would be, I think markets will internalize very quickly any unforeseen issues, if there are geopolitical issues, if there are oil shock, etc. So it is not that the markets believe you're going to do X come what may. Markets are quite good in adapting to what is going on. But there is, I think, from what you say, you're also seem to be concerned that while you have a great deal of confidence in the projections, you're worried about that some of the assumptions, given what is happening in the world, may not materialize the way.
But I think that the question of market expectations is something that I have full respect for market expectations. They are very important for us, but you know perfectly that market expectations are volatile. And there are some kind of events, geopolitical events. Markets sometimes, this is something that we are analyzing, that we are looking at, have difficulties to assess the impact of geopolitical risk. It's normal, because markets are used to dealing with financial, economic issues, and geopolitical risks are of a different nature. What might happen if there is an extension of the conflict, for instance, in the Middle East? Well, immediately you try to look at the potential impact on oil, but there are other elements, no. I am not so sure that markets are fully at the beginning fully understand the real consequences of geopolitical risks and political risks. Now, the valuations, much better than myself about valuations. You're market participants, many of you. are very rich, are very, very, very high. If you look at the risk premium, according to our views, are very compressed. If anything unexpected, and lately a lot of things unexpected happen, occur, then the reaction of the markets, and simultaneously you have to put that in the context of high leverage, illiquid assets, this kind of things. No, look, for instance, well, now we do not pay much attention to financial stability issues, but for instance, commercial real estate. It's clear that we are going to see additional decline in the prices of commercial property in Europe. What's this going to have? What kind of impact is going to have? What kind of financial instability is going to create? How do you interact financial stability with a tightening of financing conditions and with monetary policy?
Okay, thank you very much. Yes, please.
Hi, James Rossiter, TD Securities. If I compare the US to the Europe or to the Eurozone, Europe's obviously gone through a big supply side shock with the energy price increase around the invasion. Central bankers' worst nightmare, you get high inflation, weak growth. The silver lining perhaps of that is the second phase, where growth, as the supply shock fades, growth naturally picks up and resumes growth and inflation starts to come down. And arguably that's perhaps what we're starting to see in the Euro area. When it comes to sort of the policy setting, that sort of gives you an excuse almost to lower rates because you've got the supply side doing a lot of the work for you. But then you've also, as we've talked about the services side, the labor market, tight labor market. What's the relative weight of those two factors between sort of looking at the benefits coming from the supply side normalization versus some of those risks that are starting to appear on the demand side?
Well, I think that this is a good comment, a good point. Let me say something. You're totally right. In the case of our inflation, the inflation in the euro area is much more supply side driven, terms of trade and these kind of things. And if the terms of trade start to normalize, then you have a natural driver for higher growth without higher inflation. And I think that this is something that is quite positive. We had a positive surprise in terms of growth in the euro area in the first quarter of this year, and the main driver was net exports. So and a little bit of a recovery of consumption. So I think that in that respect you are totally right. The unwinding of the supply side shock and the consequent improvement of the terms of trade are going to be positive for both inflation and growth in the euro area, and this is something that we are taking into consideration, and it's part of the marginal improvement of our projections. But simultaneously, well, unfortunately, there is another element that we have to control and to monitor. That is the evolution of the labor market. I think that now is wage dynamics, productivity, unit labor costs is perhaps the prevalent force in our analysis in order to try to define the outlook and to define our monetary policy stance.
Okay, James. Okay, gentleman on the left here.
Tomasz Wilarek from T. Rowe Price. Thank you for being with us today. So I sort of had a broader monetary policy strategy question. The euro area was stuck at a 1% core inflation the pre-COVID decade, and it was very hard to bring it back up, even with QE and all these other measures that you've done. How strong is your confidence that you're not going to go back there? And then the question is, with respect to the decision last week, these kind of considerations, are we going to go back to a world of very low core CPI inflation? Do these feature in your decision? And does that mean that the ECB has to be perhaps a bit more forward-looking than other central banks in doing its policy decisions?
Well, my personal view is that we will not be back to those times, at least until the end of my mandate in the ECB. That it will be in 2 years' time. So I don't think that. I think that inflation is going to be the main risk for us. Well, the times of deflation were very nice for central bankers. It was very bad for the economy, but you increase liquidity, you reduce interest rates. Well, it's much more difficult, to deal with inflation. I can assure you. And even, I remember that, remember when forward guidance was in fashion. It was not so long ago. It was 2019, 2018. Well, we were in the lower bound, and forward guidance was very, very important. Was part of the toolkit of a central bank, to say that we will continue with very low interest rates until inflation moves towards 2% from below 2%. And now, forward guidance. Now we have another different kind of forward guidance. From people are asking, what's the natural rate? What's the rate star? It's a sort of indication. Well, markets are looking for indications about monetary policy. And you say that the neutral rate is 1%, then immediately you can deduct that your monetary policy stance is restrictive. If you say that then the neutral rate is 5%, then it's the other way around. Well, so as nobody knows exactly what's the level of the neutral rate, well, you can make different bets, no? But I understand perfectly that markets are looking for guidance. But I think that the best guidance that we can give now is that in this situation of high uncertainty, we have to be very careful, very prudent, and it could be imprudent even to give short-term guidance. But I don't think that we will be back to the inflationary times in the near term and in the medium term.
Thomas, you want to come back?
No, thanks. That's very much. That's great.
Thank you. Vittorio, please come in.
Good afternoon, Vittorio Martino from Exodus Point. I'm here in front of you, literally. It's okay. You're looking for me. Thank you very much for your remarks, first of all. I have a question about communication. First of all, it's great to understand that as an institution, you have much more confidence on the forecast that you produce, given the prudent assumptions, etc. At the same time, there are some of your colleagues that define the meetings that are not forecasting meeting, some as inter-meeting, some are intra-meeting even, and discard those meetings are those in which a decision is never going to be made. On the other hand, at least lately, President Lagarde communication during the intra-meeting, let's call it that way, or inter, has been to reinforce very much what the decision was going to likely be at the forecasting meeting, assuming obviously data confirm. Would you characterize this as sort of a temporary thing, or? But I'm not talking about the next meeting or the next 3 meetings. Yeah, I'm talking about strategy and communication.
Well, there is something that is quite obvious. Now, we release our projections 4 times per year, and this is normally in the meetings of the governing council with projections, we analyze much more in depth the outlook, the economic situation, the potential risks, the balance of risks, and this kind of things. No? So it could be usual, it would be totally normal that we take decisions in our, when we have new projections. We have as well something that it was decided in our strategy reviews that twice per year we try to incorporate to the discussion financial stability issues. Because I think that now we are not talking about financial stability, but remember what happened with the regional banks in the US or Credit Suisse And now, everybody looks very, very quiet and very reassured with respect to financial stability. And let's see, let's see, because you can have surprises there. So this, these meetings are especially relevant for us. So it's normal, it would be usual, it could not be, a surprise that our decisions are taken there. But this does not imply that we are going to take decisions there. I know that some of my colleagues in the Governing Council, they have said no. Well, they have started to say that in the meetings, in the Governing Council meetings with new projections are the ones that are going to be key. I am not so pretentious as to know what's going to happen, and nobody knows. Nobody knows. You have seen that, before the June decision, we presented the rate cut as a sort of fait accompli, and it was almost unanimous. But I hope, and I suppose that you have realized that now everybody is much more prudent. It's much more prudent than before. Why? Because we know, the difficulties that we are going to encounter, that we are going to face over the next months. The situation of the bumpy road that I mentioned before, the level of question marks that you have in the world economy, even the political, geopolitical consequences that are going to be there, and even the possibility of having a financial stability accident in there. So. I would say that now, the mood of the governing council, that is difficult, because there are 26 of us, 20 governors and 6 members of the board. And we have different views, and it's impossible. But here, I think that, after the last meeting, is clear that, I have seen a lot of, let's say, consensus with respect to the need of becoming more prudent with respect to our projections. I do not normally talk about the actions, because I have an institutional role in the ECB, and I do not like, even because I think that I have a lot of respect for the opinions of other governors, and I have to give my opinion in the Governing Council. And afterwards, you have presentations at this one or events, and you have to talk and to try to communicate. There are other governors that are much more outspoken than myself, and it's up to them. But I think that even you should try to deflate the level of how do you say in English, of level of outspoken, or I don't know, outspoken is a adjective,
a little modesty,
a little just modesty of each one.
Thank you, Vittorio. I'm going to go to the gentleman next to you, actually, and then Giuseppe, I'll bring you in. Please go ahead. Yeah.
Hi, good afternoon, Giuseppe Maraffino, Lemar. Thanks for your comment. Before you mentioned BLS, Bank Lending Survey, you mentioned a mild, moderate increase in demand for loans. I want to ask you. Now we are in a situation of ongoing liquidity tightening, even if you start cutting policy rates, but liquidity reserves continue to decline. And also there are many regulatory changes that is expected to be implemented. Also, that the stable funding ratio implementation in the euro area, in Europe, everything would increase the cost of reserves. It potentially could reduce the distribution reserves in the euro area. So this means that the funding for banks will increase. So are you concerned about tightening related to liquidity tightening that could force banks to increase the lending rates while you are easing? And this could lead the ECB to be more aggressive in the easing to offset the increase in the cost of in the lending rate by banks. And related to that, what do you think about yesterday news that Europe could postpone the introduction of Basel IV by 1 year? Thank you so much.
Well, I will start with the last point. That is the question of Basel III and the implementation of the directive. Now what I have heard, but you will have to ask the European Commission, is whether the delay and the postponement in the implementation by the US is going to give rise to an additional postponement here in our directive that was approved, that has been approved. And theoretically, there is the possibility of postponing until 12 months. But I could take all that with a pinch of salt. Why? Because, well, we have a European Commission now that is in office, but will not be in office. So let's wait for the new Commission. Let's see what happens in the US with the implementation of Basel III. We have been totally in favor of the full implementation and the loyal implementation of Basel III in Europe. Well, afterwards, discussion between the Council, the Commission, the Parliament gave rise to a little bit of watering down of the initial proposal. But as the ECB, we have always been very, very much in favor of the full implementation of Basel III in Europe. And now we have the situation in the US, so let's see. But perhaps we should wait a little bit until a new Commission arrives, no? Because I think that this is something that would be relevant. The question of liquidity in the system. This is something that we follow very closely with different measures, with different calibrations, and on average, the situation is quite comfortable, very comfortable on average. But as you know perfectly, in economics and finance, the average is important, but afterwards you have the dispersion, no? And the dispersion. But we have not identified any, tail banks, no, that might have difficulties in terms of liquidity, no. So the situation is, is something because it's incredible, how rapidly we turn the page of the different events. Remember that the regional banks, the Credit Suisse, liquidity was key. Now, 1 year after, now liquidity is something that is forgotten. Now liquidity is something that is relevant. We are monitoring that, and the situation is not bad. If you ask me about other potential, the situation of the European banks, going beyond the question of liquidity and going beyond, there is a clear improvement in terms of profitability. Even, our calculation now is the return on equity of the European banks is around 12%. That is much better than the 4% that we had pre-pandemic. But simultaneously, even though the valuations have improved quite a lot, the valuations have not gone in parallel with the improvement in the return on equity, in profitability. Why? I think that because markets believe and discount that this improvement in profitability, is not going to be sustainable over time. And so they have increased, the return on equity of the European banks has improved, but markets have improved simultaneously the cost of equity. So the valuations, even though they have improved, they have not improved as much as the improvement in terms of so the price to value is has improved, but it's even below the comparison with other jurisdictions. Why the cost of equity of the European banks has increased and has limited the improvement in valuations? I think that this is a very important question. This is something that we have to look at. I think that there are different elements. The first one is that the growth rate of Europe is not going to be brilliant. That's something that is a reality. The growth rate is going to be, if you look at our predictions, and this is something that we will have to, I think that we should dedicate more time in the future. Why the growth potential of Europe is so low, but is below the US level. Second, because they are discounting that we will have from very low levels an increase in non-performing loans. Third, that we are withdrawing liquidity from the marketplace, and so banks will have to compete a little bit more in terms of deposits, and so they will have to increase their remuneration, even in a context of that we are not increasing further interest rates. And fourth, I think that the lack of a banking union in Europe is having an impact as well. I think, well, the banking union, a complete banking union, we do not have a common deposit insurance scheme, as you know. And finally, I think that issues as taxation on profits that is something, a decision taken in several countries, also created a little bit of uncertainty. These are liquidity is important, and we are paying more attention to. We do not see, short-term problems. We do not see even short-term problems in terms of capital, in terms. But I think that the improvement in profitability, there is a little bit of an illusion in my view, and I think that markets are not buying the whole story. This whole story about the improvement in profitability over time.
Would you like to come back in?
Thanks a lot for this comment. Just a very quick follow-up question. When you mention US, the fact that they are still working on that, it's very likely that they will change but the end game, Basel III end game, making it, I would say, less strict than the initial version. Do you think Europe should do the same in order to have the same level for banks on both sides of the Atlantic? Thank you.
I hope that the US will have a full implementation of Basel III. I think that, the first, the situation in the US is complicated now. They have elections. I don't know whether, the timing was the best. These kind of things that, are always, very, they attract a lot of lobbying, as you know perfectly. But what I wish for Europe is the full implementation of Basel III, because we believe that that's the correct way forward.
Thank you. Please, Giuseppe.
Giuseppe Vera, Citadel. Thank you for your time today. How would the ECB look at a period of elevated and volatile sovereign spreads, perhaps associated to fiscal concerns? Because on the one hand, it's tighter financial conditions. On the other hand, maybe it's more growth or less fiscal consolidation. Thank you.
Well, the situation in the sovereign bond market has been very, very quiet lately, letting aside what has happened over the last 2-3 days, no? But if you look at spreads, they have been pervasively narrowing. So, well, that's very, very, very good news. And perhaps, something that, I am not going to try to compensate, previous sufferings, in my previous job as finance minister of Spain. But what is very good and very nice is that if you look at now, the situation of Greece, the situation of Portugal, even Italy, Spain, etc. Now, they are isles of fiscal stability, at least in the short term. And I think that, when you see that, Greece or Portugal are upgraded, it's an indication that perhaps, the policies implemented 10 years ago worked. And at the end of the day, after sufferings and after hardship, people start to pick up the rewards and the fruits. But I don't know I think that fiscal, in general terms, is going to be important. We have new fiscal rules, as you know, that are much more sensible than the previous ones. I don't know what's going to happen, because this year is going to be complicated, because we'll have half a year with the old fiscal rules, because theoretically the European Commission has to, to publish the EDPs of the countries that are going to be subject to EDPs. But simultaneously, in September, according to the new rules, the governments will have to submit to the European Commission the 4-year, 7-year plans, budgetary plans. So I don't know how they are going to dovetail both processes. I think that it's not going to be easy because simultaneously there is another factor. The old rules are going to be applied by the old commission, and the new rules will be analyzed and assessed by a new commission. So this is something that we will have to find out. But fiscal, in my views, is going to be more and more important.
Okay, Giuseppe, yeah. Just related to that, of course, you yourself referred to political risk now coming onto the radar. To what extent do you see the risks feeding into euro area policies and fiscal attempts to restore some fiscal discipline, really? How do you assess that?
Well, we have new fiscal rules that were approved, very lately. And I think that it was in the first quarter of this year. These fiscal rules are much more sensible than the previous ones, because the previous ones were not, it was totally out of the question to implement those rules. I think that it's going to depend a lot on the new commission. Well, we have paid a lot of attention to the elections and the composition of the parliament. That I think that is something that is very, very important, because it gives an indication about how politics are evolving at the national level as well. But you have to bear in mind that in November, theoretically, we'll have a new commission. And the commissioners, I suppose that you know how they are elected. Well, they are elected because they are put forward by each one of the governments, and they have to be voted in the parliament, and it has to be approved in the parliament. But normally, well, the composition of the commission and the characteristics and the features of the commissioners and the political, the ideology, because at the end of the day, the commission is a political entity of the commissioners is going to have an influence, no? And if you look at the political landscape in Europe, well, it's clear that not as much as a consequence of the elections, because the elections at the end of the day, you have a majority of the very pro-European. You have the Popular Party, the Social Democrats, the Liberals, the Greens, that they have a clear majority. But we have seen that now the majority of the governments, they have they are more conservative than the ones that appointed the present commission, and this is going to be reflected in the kind of candidates that they will present.
Okay, a gentleman on the top left there. Yes, please.
Hi, Sean Reitetal, Vanguard. Thank you for your comments today, Vice President. My question's about profit margins, which you alluded to earlier, and specifically an article published by the ECB maybe a week or so ago about how elevated profit margins may have given firms capacity to hoard labor during times of weakness. And now that the outlook is profit margins are falling, there are downside risks to the labor market. Maybe you could talk a little bit about your views on that, the labor market more generally, especially in the context of the unemployment rate being pretty stable for the past year or two, and then kind of any thoughts there?
Well, I think that one of the positive surprises that we have had, and I think that is one of the most positive developments that we have seen, is what's happening in the labor market in Europe over the last what has been happening over the last 3-4 years. No, the labor market has been quite strong. It's not only the unemployment rate; it's as well job creation, hours worked, and even the participation rate that has been on the rise as well. So very good news from the labor market standpoint. That I think that is very positive, even in terms of financial stability. For households, the main element why we are not seeing a sort of tension, even though we increased interest rates and the cost of mortgages was clearly on the rise, and these kind of things didn't give rise to an important increase in non-performing loans in the mortgage market. Is the good evolution of the labor market. We have started to see, and this is part of the analysis, that now perhaps the labor market employment creation has started to slow down a little bit. We believe that this can happen simultaneously and in parallel with a small recovery of activity of output. So you will have an improvement in output. You will have a slowdown of job creation. So the consequence is that productivity will go up from very low levels, but will go up. And this is going to be a helping hand in terms of unit labor costs. With respect to margins, our analysis indicate that in 22 we had a very important improvement in margins, in profit margins. And it's something that you can look at very clearly in the GDP deflator, how profit margins were one of the main contributors to the to the increase in the GDP deflator. In 23, it was a little bit the other way around. And we believe that this improvement in profit margins was key to buffer the increase in unit labor costs. We feel and we believe as well that at the beginning we do not have numbers on profit margins for 24 for this year, but we believe that this might be happening as well in 24. But this cannot happen forever. It's something that is not sustainable. So we expect that in 24 perhaps it will continue. Profit margins will continue playing a role of a buffer. Absorbing part of the increase in unit labor costs, but we expect that for 25 the situation will be different, and that unit labor costs will moderate the growth, and so profit margins will be able to increase a little bit beyond the mission of buffering the increase in unit labor costs. That's our prediction. That's why that's one of the elements that really supports our projection for an inflation coming back to 2% in the second half of the year.
Would you like to come back? No, thank you. Vice President, you've been good enough to respond to a lot of questions. I'm wondering if you have one or two you'd like to put to our audience, please.
Well, the first one is what's your reading of the European elections? What might happen, and the kind of influence that the composition of the new parliament might have in the process of European integration? Do you think that the outcome is going to be, let's say, pro-European integration, or we are going to have a sort of, let's say, a slowdown in that process, or even that the process will come to a halt?
Do we have any political analysts amongst us? Marco.
They won't, as you know better than me, the majority will not change much. Policy will shift from green to defense. Maybe there was some hope on the defense side to have some fiscal integration and common issue there, which would be a positive. The major issue, I think everyone would agree, is France now, and doesn't bode well for integration. They usually rule in Europe that we do progress when there is a crisis. So we're not already brilliant prospects, and now things have not improved. We're not speaking about Frexit. I don't think anyone is worried about that. But the question that I think Giuseppe asked before was not about the peripheral fiscal slippage. It was about a country that has got a 0.2 weights in GDP and it's not Germany, it's not the peripheral. So it's worry about France and how you would react to that fiscal slippage. So that is the main word.
If I may add something, please. The discussions will be very, very difficult around the new budget for the European Union, assuming that there is a desire to expand the European role on the defense expenditure side, without touching any of the existing policies. I don't understand personally where I sit how the council, the governments can agree on anything. I mean, there are obvious, ways to go about that, increasing contribution to the budget, increasing our resources of the EU, or increase the role of one of the European financial institutions, or indeed doing more debt. I don't see government being able to agree on any of those. So to answer your question, it's going to be very, very difficult.
Anybody else would like to?
I just add one thing to the
Fabio.
one thing that does leave me a little bit worried about the European election, you hear from everywhere, is that the current majority is still there. And that leaves me a little bit worried, because if we think that people change and we can just keep doing the same things, it looks to me like in 5 years, the right wing is going to get even a bigger share of the pie. So I do want to hope that von der Leyen, once she builds the new majority, she does account for the shift to the right in the parliament, because it would worry me to have a majority, let's call it in Europe, that leaves out the largest party in Italy, and at current state, the largest party in France. So I hope that there is some acknowledgement of that when Europe is ready to build the new majority.
Partha from PG Advisors. So my take is very simple. If you look outside the European Union, what happens in US in 2025 and UK is going to influence a lot of how Europe reacts. And I think Europe is going to find a new way. I don't think there's going to be any meltdown or anything, because the markets are pretty stable. I think the whole liquidity part is well addressed. I think you talked about growth and service side. I think that is the part which European Union is going to find as new turf. Probably there's an opportunity, is what I would say. So that's my short take. But I do have one question for you. So if I add, let's assume hypothetically, add a profile of a magician to your profile, you have been a businessman, you've been a politician and economist at heart. If you were a magician and there you had a wand and you could change one thing, what would that be?
Well, I could change, because I agree with you that, there is the danger that, the illiberal principles in the world are on the rise. I would change that.
I thought you were going to say a certain Spanish tennis player would win Wimbledon, actually.
No, but, going back to, Sinner, I think that Sinner might win. Sinner is more mature, he's more mature, because he's 2 years older than Alcaraz. I think that, that Sinner is an incredible player. He's very mature. I know a little bit, because I played semi-professional, 50 years ago. 50, no, 40 years ago. And I know a little bit, and, tennis is about, mental, power.
Sure.
And because, for instance, in the final of Roland Garros, Zverev was harder. You saw that he could play harder even than Alcaraz, but Alcaraz won. Why? Because he was a little bit more talented, and creativity in life is important. And I think that in terms of brain power, he was stronger than. And that's something that I think that, for instance, talking about football, talking about important things, England has the best team for the European Cup. But the question is how competitive they are. Sometimes
very talented team, but not the strongest psychology.
Sometimes the best, I am a supporter of Atletico Madrid, and I have, to bear Real Madrid.
Cards are now on the table. Our time is virtually up. I'm going to leave a last question to my M&I colleague, Santi Pignol. Santi.
Well, changing the topic now, it's a bit hard, but you talk that we are in a dark room, and also that there was consensus coming from the meeting about prudence, but also we have seen consensus on greater confidence on the projections. So I was wondering if this greater confidence in the projections can put a little bit of light in this dark room, and when do you expect that projections return to be the main communication tool for the ECB? Or what do you need to see to that to happen?
Well, it's quite clear that what we need to think, to see and to perceive is a reduction of uncertainty. I think that's not going to happen over the next 6 months for sure, and perhaps, unfortunately, a little bit longer. But I think that the drop in uncertainty could be, the key element. Okay.
I put my microphone on. Thank the Vice President very much indeed for joining us today and for being so generous, really, with your responses to all of our questions. The main message I took, I think, is that that you are quietly confident that you are on track. But one thing I'm struck by is the degree to which you emphasize the uncertainties. In fact, I would describe them as very elevated, and for that reason, you cannot be too confident. So I thank you very much indeed. I thank our audience for all your participation and for joining us today. And I thank everybody who's listened on live stream as well. For the audience in the room, we have a drink reception. So I'd be delighted if you join me just next door in the atrium. Thank you once again, Luis. Thank you very much indeed. And I bring this M&I Connect event to an end. Thank you all.